Why do most people lose money in the stock market, while some investors consistently build wealth for decades? It's not because they are smarter, and it's not because they can predict the future. It's because most beginners invest randomly, following news, hype, tips, and emotions, without any real strategy. Meanwhile, successful investors follow a philosophy. In fact, two investors can buy completely different stocks, follow completely different strategies, and both still make money. So today, let's understand 8 of the most famous investment philosophies in simple terms. 1. Value investing. Value investing is all about finding stocks that are undervalued. These investors believe the market sometimes makes mistakes. A good company's stock price may fall because of fear, bad news, or temporary problems. So value investors try to find companies whose real value is much higher than their current stock price. Their mindset is simple: buy great businesses when they are available at a discount. 2. Growth investing. Growth investors care less about how cheap a stock is and more about how big the company can become in the future. They look for companies growing revenues, users, or profits very quickly. These companies are often expensive today, but investors believe they can become much larger in the future. The idea is simple: a rapidly growing company can eventually justify a very high valuation. 3. Momentum investing. Momentum investing is based on one belief: stocks that are already rising tend to keep rising for some time. Instead of finding cheap companies, momentum investors focus on trends. If a stock is moving up strongly with high demand, they ride the momentum until the trend weakens. In simple words, the trend is your friend. 4. Index investing. Index investing is one of the simplest and most popular investing philosophies. Instead of trying to beat the market, you simply become the market. Investors buy index funds that track indices like the Nifty 50 or S&P 500. So rather than betting on one company, you own small pieces of many companies at once. This reduces risk, requires very little research, and works well for long-term investing. 5. Dividend investing. Dividend investors focus on companies that regularly share profits with shareholders. These companies pay investors cash dividends every quarter or every year. Usually, they are stable, mature businesses with strong cash flows. The goal here is not just stock price growth, but creating a steady stream of passive income. 6. Contrarian investing. Contrarian investors do the opposite of the crowd. When everyone is excited and greedy, they become cautious. And when everyone is fearful and panic selling, they start buying. Because markets often overreact emotionally, good companies can sometimes become extremely cheap during market fear. This philosophy requires patience, confidence, and the ability to ignore public opinion. 7. Factor investing. Factor investing is a more scientific approach to investing. Researchers discovered that certain stock characteristics, called factors, have historically delivered better returns over long periods. Some famous factors are value, momentum, quality, small cap stocks, low volatility. Factor investors build portfolios around these characteristics instead of relying on gut feeling. 8. Quantitative investing. Quantitative investing is where finance meets mathematics and technology. Instead of humans manually picking stocks, computers analyze massive amounts of data using algorithms and models. These models look for patterns, probabilities, risks, and opportunities across thousands of stocks instantly. Quant investing removes emotions from decision making and relies heavily on statistics, coding, and automation. So, which philosophy is the best? There's no universal answer. Some philosophies work better during certain market conditions. Some match different personalities and risk appetites. But one thing is certain: successful investors don't invest randomly. They follow a clear philosophy, stay disciplined, and stick to their process over time.